welcome. I'd like to welcome all of you to our March 13th program. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and we are delighted to have Christine Benz as our presenter today. A couple of housekeeping comments. Because we're going to have a large number of attendees, the only practical way to field questions is to use the chat line. So if you look at your display in the lower center, there's a little window with chat underneath it. You can click on that, type in your question, and then we'll bring the question up either immediate or at a particular break point, and we'll in some cases combine questions. And that'll just make it a lot easier to get everything in here. I'd like to start off I'm going to read a couple of things from Christine's bio. She is Director of Personal Finance at Morningstar and Senior Columnist for Morningstar.com. She is the author of a number of books, including 30-Minute Money Solutions, a step-by-step guide to managing your finances. She is co-author of the Morningstar Guide to Mutual Funds, 5-Star Strategies for Success, a national bestseller in 2007, and the second edition was published in 2003. Second edition was published in 2005. Before assuming her current role in 2008, Christine also served as Morningstar's Director of Mutual Fund Analysis. She has served as editor of several publications over the years, including Practical Finance, Morningstar Mutual Funds, and Morningstar Fund Investor. She has worked as an analyst and editor at Morningstar since 1993. Christine holds a bachelor's degree in political science, Russian/Eastern European studies from the University of Illinois at Urbana-Champaign. I received an email from Fred with a quote from a Morningstar publication, Smart Money, dated March 12th. And I'm going to read a couple of excerpts in there because it illustrates one of the recent awards that Christine received. Quote, Morningstar's Director of Personal Finance, Christine Benz, has been named one of Barron's 100 most influential women in U.S. finance for a second year, coinciding with the International Women's Day. Christine is more than worthy of this accolade. Her work embodies what smart investing is all about: putting your goals first, saving diligently, controlling the factors you can, such as taxes and costs, and keeping your investments simple yet diversified. No shorting, cryptocurrencies, or celebrity endorsements required. Christine's advice is the thoughtful, common sense anecdote to the get rich quick mindset dominating our financial media today. Congratulations, Christine, and keep the great financial advice coming, unquote. Christine's presentation is titled Retirement Planning in Uncertain Times. We are certainly in uncertain times with the pandemic and economic weakness. So I'm going to turn the time over to Christine and welcome to our chapter.
Thank you so much, Lynn. I hope everyone can hear me okay. I am so sad that I can't be there in person for a couple of really selfish reasons. One is that my two best college friends are both in the Bay Area, one in Napa and one in Berkeley. So I usually am able to tie in my visits to your chapter with some quality time with my two girlfriends. So I'll miss that. But I have to say, another aspect of this pandemic and presenting via Zoom or some of the other formats that we've been using is just that I miss the face-to-face interaction that I have with so many of you that I have had, and selfishly speaking with you and hearing about what's on your mind, hearing about the strategies that you're employing, hearing about your questions gives me fodder for what I should be working on in the future. So I'm hoping that at some day in the future, I will be able to get back out there because I truly do enjoy and learn from all of you. But we will have some time for questions. I'm going to be giving two presentations today. One, as Lynn said, is called Retirement Planning in Unprecedented Times. And it focuses on a lot of what I focus on in my work at Morningstar, which is the retirement decumulation years, the more I have focused on financial planning and portfolio planning, the more I've concluded that accumulating assets for retirement is truly the easy part. The difficult part of creating a retirement plan is figuring out how you will decumulate it. And I think that there are a few factors at play in the current environment that make retirement planning, especially for new retirees, particularly challenging today. So that's what I'll hit on in this first presentation. Then we'll take some questions and take a short break. And then in the second presentation, it's a revisiting of a presentation that I've given to this group before, and it's about best ideas in terms of investment ideas for your portfolio. And it takes a spin through Morningstar.com, some of the tools and features that we have on Morningstar.com to show you how to surface investment ideas if you're perhaps looking to freshen up your portfolio a little bit at this juncture. So that's part two of the two presentations today. But I'll get right into this presentation. Let's see if I can advance my slide here. Okay, just a quick Morningstar overview. I promise this won't be a Morningstar commercial, but, and I know many of you are familiar with Morningstar, but just to give you a quick overview, we provide investment research to a lot of different entities, really three main groups: individual investors like yourselves, financial advisors, as well as institutions. So one of our larger businesses is providing financial advice to 401k participants, where we offer managed accounts for people in 401k plans. And we also advise on target date funds. So those are our three main audiences. But we do view our competitive edge in this marketplace as having great bottom-up research. We provide research on mutual funds, which many of you know us for. We have a growing team focused on passively managed products, because if you look at where fund flows are going, the marketplace is very much telling us that passively managed investments are where many investors choose to focus these days. So we have a growing research effort there. We also have research on individual stocks. We have research on health savings accounts, on the major health savings account providers, 529s. Much of this research and data is free. Really, the dividing line, if you come to Morningstar.com, between what is available to you on a free basis and what's part of our premium service is that any of the written analyst reports that include ratings on funds, not star ratings, but our analyst ratings, which are meant to be forward-looking, or the star ratings for stocks, which are meant to give you a view of how well we think a company will perform going forward. That's all behind the premium wall. But the site has a lot of great free information. All of my stuff is free, so I write regularly on Morningstar.com. I also have model portfolios and do a lot of videos. So you can find all of my stuff in front of the free wall. So you will not need to pay to view my article or any other articles on the site. One thing I wanted to touch on real quickly is that Morningstar has a growing effort in the environmental social governance space. And I know some investors really have no interest in this area, but some investors have a lot of interest in this area. And we find, especially among younger audiences, that there is an appetite to have investment portfolios aligned with broader sort of goals or values. And so that is why we have been investing heavily in this area. We acquired a company called Sustainalytics last year, which is bringing us a lot of heft in this area. So look for more from us in that space going forward. If you come to Morningstar.com, you've probably already seen a fairly significant emphasis on that area. My view is that some investors aren't interested, some are. For those who are, we want to make sure that we're providing them with tools to make smart decisions that also help align their portfolios with their values and help align their portfolios with good forward-looking risk-reward prospects. So that's just a quick overview of Morningstar. I want to just start out by talking about just a quick quote from Sir John Templeton. We heard this in the .com period. I think it's reasonable to be kind of thinking about this again. The four most expensive words in the English language are "this time is different." And as you remember, we heard that in sort of the late 90s period where there was this idea that we should all just put up with sky high equity valuations, that these companies would grow into them. And I'm hearing a little bit of that recently, that sort of sense that investors should just be able to deal with very high valuations and not worry about them. And anytime I hear that, it gets me a little bit concerned. So just a quote to get us started. Thinking about what is not new about our current predicament. Well, we've had global pandemics before, most recently the HIV/AIDS crisis in the 80s. We've had high equity valuations before. We've had low bond yields before. What's a little bit different about the current time period is that I don't know that we've had these things working together all at once in the past. And that's where we are today. And I think that creates some unique challenges for people, especially people who are just about to embark on retirement. For those of you who are further in your retirement careers, I think you probably have a little less cause for alarm because you have made it through what retirement researchers think of as the really kind of scary part from an investment standpoint for a portfolio. You have made it through your first decade or more of retirement, possibly. The people who need to be most concerned about the specific variables at work today are people who are just embarking on retirement. So I'm going to talk about the implications of all of this for retirement planning from a couple of different angles. So I'll start by talking about asset allocation and what to think about when assembling a portfolio. I'll talk about withdrawal rates because many of you know that's one of the most important determinants of whether or not your portfolio is sustainable throughout your retirement career. I'll talk a little bit about withdrawal method, and I think that this gets less play, but it's really important to come into retirement knowing where you will go for your cash flows on an ongoing basis. So will you use sort of the old school approach where you draw your cash flows exclusively from income producing securities? Will you use a pure total return approach where you take your withdrawals strictly from rebalancing and trimming appreciated securities? Or will you possibly use a combination of the two? So I'll touch on how to think about that. And finally, I'll spend a little bit of time talking about the role of non-portfolio assets in all of this. Because one thing we know is that those lifetime assets that all of us will be bringing into retirement are really impactful in terms of how we manage our investment portfolios. So I'll share a little bit of thought on some of those issues. I'll also touch briefly on annuities. And I know many retirees automatically, especially investment savvy people automatically have their hackles go up when anyone mentions annuities. But I think that there is a case to be made for annuities in some situations, certain types of annuities, not all annuities, but certain types of annuities. So I'll touch briefly on that as well. So let's just start by thinking a little bit about this assertion that we're in this high valuation environment. And you can examine this assertion from a few different lenses. And I would start out with a really basic one, which is the Shiller cyclically adjusted price earnings ratio, sometimes called Shiller PE or CAPE. And this is a measure that Robert Shiller has been tracking for a number of years. And it's been flashing warning signals for the past few years. Probably last time I was in town speaking to your group, we probably showed a slide somewhat similar to this. And you can see that Shiller PE is elevated relative to history, that it got really high back in the late 1990s, early 2000s period, shortly before that crash. But today, with a Shiller PE of roughly 36, we're roughly double the median and mean Shiller PE. So for people who are bearish about the US equity market, and this is for the S&P 500 in terms of Shiller PE, they would often point to something like this. So this is kind of a starting point. Based on traditional measures like this, stocks appear to be pretty expensive relative to history. This is another view of the matter, and this is our analysts' bottom-up view. So we have, as I mentioned, we have an effort in individual equity research, and when we ask our analysts to cover companies, to value companies, we ask them to come up with a fair value for what the company should be worth. So an example would be if the analyst thinks that the company is worth $100, but it's currently trading at just $80, well, then the price to fair value would be 0.8. If that $100 fair value company were trading at $120, well, then the price to fair value would be 1.2. So what you see on this slide is that today, when we look at all of the companies in our global coverage universe and kind of roll them up, what we see is a price to fair value for that universe of 1.05. So not incredibly expensive. I included the historical price to fair values for our coverage universe. You can see that early in 2020, when we had that mini bear market that was quite short-lived, you can see that stocks got really quite inexpensive relative to their fair value for that coverage universe. It's been off to the races ever since, more or less. And so we are trading over fair value right now. But I think you can dig into this and get a little bit more nuance. So if we look at this on a sector by sector basis, which you can do, you can see that there are certain parts of the market that appear to be especially overvalued, and a small handful of those that are more attractively valued. So in the overvalued camp would be basic materials, consumer cyclical, which would be some of the retailers, restaurants would tend to land there. Industrial companies, all looking a bit expensive to us today. Technology, somewhat expensive. Whereas only one sector looks extremely cheap to us today, that's the energy sector. Utilities also looking somewhat inexpensive. So a little bit of nuance here. I think it's interesting that at this juncture where we've kind of gone into risk on mode, where investors seem to be quite bullish on the prospects for the economy, we see some of the more defensively positioned companies and sectors in the right-hand column there, looking a bit more attractively valued relative to some of the more cyclically oriented, economically sensitive companies. So I think that that's an interesting piece of nuance, and it kind of syncs up, I suppose, with the general point in the economic cycle right now, that I think there is a general sense that after people are vaccinated, after we hope things get somewhat back to normal in 2021, that there will be this great unfurling, a lot of pent-up demand and a lot of economic activity. So I think that's what the relatively better valuations of the defensive companies are saying, that investors aren't so worried right now. They're less inclined to be attracted to some of the more defensive companies. They want to be in those companies and sectors that they perceive to be highly leveraged to the economy's fortunes. So this is just a kind of another lens when you're thinking about market valuation today and thinking about how that might be reflected in a retirement portfolio. This is a view of our Morningstar style box, and I know that many of you are probably familiar with it, but this is our price to fair values as of the end of 2020 by Morningstar style box. And I'll just describe what we're looking at for those of you who aren't familiar with it. This basically arrays the market and it arrays our coverage universe by size and investment style. So in the top left, you have large cap value companies. That's where most of the major banks would tend to live. That's where the energy companies would tend to live your large energy producers. That's large value. At the opposite corner of the style box would be small growth companies, so rapidly growing companies with small market capitalizations. In the middle would be what we would call core or blend style companies. So those would be companies with a mix of growth and value attributes. So the pharmaceutical companies would tend to land in large blend, for example, where they have some growth attributes, but they're not the fastest growing companies in town. Some of the consumer staples would tend to land there. So like a Procter & Gamble would probably be large blend. So from top to bottom, large cap on the top, mid cap in the middle row, and smaller companies in the bottom rung. And so we can look at our price to fair values across this style box. And I think there are some pretty clear patterns emerging when you look at this style box as of the end of 2020. One is that small value has been deeply unloved, even though there are people who really believe that it's a place to emphasize in a portfolio for the long haul. We've come through a really weak period for small value. Certainly by the end of 2020, we've seen actually a sharp reversal of that so far in 2021, but through 2020 was pretty stark that large and mid cap growth was the place to be. And so that has implications for valuation, where large growth stocks are significantly overvalued based on our bottom-up view. So about 28% overvalued as of the end of 2020. Mid-cap growth stocks more overvalued still. So roughly overvalued by roughly a third, more than a third on average. So this is just kind of another way to think about your portfolio. And if you've been someone who's hands off with your portfolio and you haven't made any changes, to me, this suggests that if you are thinking about doing some realignment, that you might think about adding more to your value holdings. Even though we have seen a little bit of a snapback in value, there's probably still some gas in the tank based on our bottom-up view. So this is just another lens to think about market valuation, potential overvaluation in some areas, undervaluation in others. This slide is a look at foreign stocks performance or foreign stocks projected returns. So this looks at the major asset classes. This is it's a separate methodology that our investment management team uses. And basically it doesn't use the bottom-up system that our equity analysts would use to look at the market. This is simply looking at expected dividend growth rates, PE expansion or contraction, price earnings multiple expansion or contraction, as well as earnings growth. So our team bundles those two things together to come up with forward-looking prospects for the major asset classes. And so a couple of things jump out at me when I look at this. One is that it's overly, or I would say somewhat pessimistic, certainly relative to what we've experienced over the past decade. So you can see that they're expecting better returns from developed markets equities as well as emerging markets equities, but they're sure not expecting much from US equities. So this is meant to be forward-looking over the next decade. Nor are they expecting much from bonds or cash, as you might expect given starting yields. So a fairly sobering picture, but just kind of a way to think about the fact that we have had a tremendous run in the US market and that foreign stocks just have not come along for the ride. So there may be more upside in non-US names than US names today. Looking at other firms' prospects, forward-looking prospects for the market, and I periodically prepare this compendium of forecasts from various firms, including our Morningstar investment management team. What you see is, I would say, varying shades of pessimism over the US market and relatively more sanguine view about the prospects for non-US stocks. So BlackRock, you can see notably better return expectations for US large caps, but also in line with our Morningstar Investment Management team, better return prospects forecasted for non-US stocks as well. Research Affiliates does its forward-looking projections a little bit differently. They do inflation adjust them, so you can see some alignment with what our Morningstar Investment Management team was forecasting for US equities. They're forecasting better results for non-US. Again, these are real inflation adjusted numbers. Vanguard, I would say, is directionally aligned with the others as well. So more muted returns for the US market. These are nominal return expectations, so not inflation adjusted. So more muted for US stocks, but better return expectations for foreign stocks. When we look at the prospects for fixed income assets, they're more settled. And the reason is that current yields tend to be an enormously good predictor of what you can expect from bonds over the subsequent decade. So this slide I just grabbed from a research paper that my colleague David Blanchett worked on, but this slide describes that relationship, that starting yields are quite predictive of what we as bond investors are apt to earn from the asset class. So even though we've seen yields tick up a little bit so far in 2021, we're starting from a very low point. And so that tends to predict pretty low returns from fixed income assets over the next decade. So going back to that Morningstar Investment Management slide, you can see that the return expectations for cash, for high quality US bonds, so under US aggregate bonds, we're looking at some pretty low numbers. And these are not inflation adjusted figures. So there is the potential for pretty muted returns for fixed income investors over the next decade, which is not to say I don't think you should have fixed income in your portfolio. I think that retired investors absolutely need fixed income to be kind of that shock absorber during a period like the first quarter of 2020, where you have something in your portfolio that holds its value during such a period if you need to be raising cash for any reason. But it suggests that you would not want to think about fixed income as a major return engine for your portfolio. Even though it has been great, it's been a great place to be on a risk-adjusted basis over the past couple of decades. Looking at where starting yields are today, the return prospects are not great for fixed income. I just want to describe, before I leave this slide, what we're looking at with the two sets of bars. So we have sort of those aqua bars. Those are the 10-year forward-looking forecasts for the asset classes. The green bars, which you can see are all dipping down into the negative, those are capturing the change in the fourth quarter of 2020 in terms of our asset class return expectations. So as the market went up, as US stocks went up, we trimmed our forward-looking forecast for US stocks even more. So those are what those two sets of bars on this slide represent. So how about if we go outside Morningstar and sample some other firms and what they're thinking about fixed income prospects? Well, here you see much less variation because I think it's very much settled that starting yields will be predictive of what bond investors are likely to earn. So to a firm, you can see a lot of alignment here where return prospects are very, very muted over the next decade from these various firms. Another thing I would draw your attention to is the fact that we have seen this great hunt for yield. And so we have seen the yield differential between high quality bonds and lower quality bonds really shrink over the past few years, as there has been this mad scramble for income producing securities. And so that's what we're looking on on this slide. This is a data point that the St. Louis Fed tracks on its website. And incidentally, they have a lot of great data and charts and visualizations on the Fed website that I would urge you to check out if you're interested in this sort of thing. But what you can see on this slide is that there are periods in time where we see that yield spread spike up, and then periods of time where investors kind of go into risk on mode, which is where we are today. And so we see that yield differential between higher and lower quality bonds really shrink quite a bit. So in the middle of the slide, you can see kind of the financial crisis. Well, we saw yield spreads really widen out, and that was a great buying opportunity for people who are interested in lower quality bonds. When we see yields condense in this way, that's a general flag that you want to be careful. You're not getting paid a lot more in terms of your yield in order to take on that risk. So I think that's kind of where we are today, that you'd want to be careful about venturing into higher yielding securities. So you can see when you look across these firms, and that was something we saw in that Morningstar investment management slide, yields are still higher in absolute terms on some of these higher yielding fixed income securities. And so return prospects are commensurately higher as well. But of course, what comes along with that is the prospect for more volatility, the prospect for indeed real losses if you need to sell out of any of these asset classes when we're in a period of market turbulence. So that was really something we saw in stark relief in the first quarter of 2020, where we had this mad scramble for really everything, out of everything except for cash during that period. And so high yield bonds, emerging markets bonds, riskier fixed income asset classes all got hit pretty hard during this period. So this slide is simply saying, yes, you will probably get paid more for assuming a higher risk, higher yielding posture in your fixed income portfolio, but the downside is that you're getting more equity sensitivity, more sensitivity to what's going on in the economy. And so you're not necessarily getting the ballast that many of us look to our fixed income assets to provide. So when we look at this data, what are the implications? It's been kind of a data dump. What are the implications for thinking about your in retirement asset allocation? Well, I think it points up a key challenge, which is that as we enter retirement, given how high valuations are today, as well as how low yields are on fixed income securities, that you're really balancing a couple of key things. You need equities for growth, because for many of us, retirement will be a 25 or 30 year or even more or even longer proposition. So you absolutely can't afford to hunker down in really safe investments because the return potential is really low. So you need the growth that comes along with stocks, but where we are with valuations, you also need to make sure that you're protecting yourself against what retirement researchers call sequencing risk. And that basically means the risk that you will embark on retirement and then encounter a weak market environment right out of the box. And that's less a concern if you've been retired for 10 years or so. You have essentially made it through the real danger zone for retirement. But if you encounter a bad market environment in the early days of your retirement, that's where you can really do some damage to your plan if you haven't adequately de-risked your investment portfolio, if you haven't set aside assets that you could spend through if you needed to without having to touch your equities. Because the real risk for an equity heavy portfolio in a period of bad market returns that occur early on in retirement is that if you're overspending from a too risky portfolio, you're leaving less in place to recover when the market actually does. So that's why it's really important to take care. If you're in the early years of your retirement or you're about to retire, it's important to really take care to make sure that you have your near-term portfolio withdrawals protected so you're not having to withdraw from your equity assets. So that's basically what you are protecting against when you hear about sequence risk. And I always make the point that sequence risk doesn't just apply to retirement, even though that's the context we usually hear about it in. It also applies if you're saving for college, for example, for a 16-year-old. You really would want to make sure to protect that portfolio once the goal date gets close. It also applies, I've been making this point to younger investors who have had some success in the equity market over the past couple of years. If they're saving for retirement, great, stay risky. But if they're saving for closer term goals, like a home down payment or a wedding next summer or whatever it might be, they need to de-risk that portion of the portfolio that they expect to spend soon. And that might be the whole amount in the portfolio if they're saving for, say, a home down payment. So sequencing risk, it's especially important as we're planning our retirements, but it's important at other life stages as well. So how do we protect against sequencing risk? Well, one thing I have been thinking about is this idea of the shape of a glide path in retirement. And glide path simply means how you are structuring your portfolio throughout a specific period. So are you taking stocks down throughout retirement? That's sort of the traditional in retirement glide path that you maybe at age 65 have the riskiest portfolio that you'll ever have in your life, but then you gradually take risk off the table as the years go by. That's kind of the standard glide path. It's also the glide path that target date funds use, for example, where they might start people in their 20s out with 90% equity weightings, but then gradually take it down as retirement draws close. That's kind of the standard glide path where equities go lower, bonds and cash go higher as the goal date approaches. A reverse glide path, though, has been posited as a potential way to think about mitigating sequence risk. So for those of you who are getting close to retirement or maybe early in your retirement, you would think about coming into retirement with a pretty conservative portfolio. And then once you've circumvented the big risk, which is encountering a really bad market early on in retirement, once you've made it through that danger zone, then you begin to increase your portfolio's equity exposure. So this was an idea that Michael Kitces, who's a guru in financial planning, and Wade Pfau, who's another kind of retirement research guru, they wrote a research paper about this idea about 8 years ago, where they talked about this rising equity glide path, where you start conservative and then add to equities. It's a controversial idea, and the big issue there is whether older adults, especially after they've gone through a traumatic bear market early on in their retirement, will feel comfortable adding risk to their portfolios later on. I think it's an open question. But it does strike me that when we're thinking about perhaps overextended US equity valuations, that this general idea is a way to think about protecting ourselves from a bad sequence risk early on, whether that materializes in the next 10 years or 15 years or whatever it might be. And again, this is all less relevant for those of you who are later in your retirement. You've basically made it. You need to worry less about this if you've been retired for 10 years or more. It's mainly relevant for people who are getting close to retirement or who have just started retirement, where you might think about, well, maybe I want a more defensive position to my portfolio with the acknowledgement that I would ramp up later on. If we do have a bear market, I would potentially add to stocks after that point. So this bucket approach, which I know I've talked to this group about before, kind of gets at that same general idea. So I'll just go back over this. I know many of you have probably heard me talk about this bucket strategy and describe what we're looking at here. This is a strategy that was introduced to me more than a decade ago by a financial planner named Harold Avensky, who is a finance professor at Texas Tech, and to me, one of the leading lights in financial planning, retirement planning. And he mentioned to me that he was using this general bucket setup with his clients. So he said that he was holding a cash bucket alongside the balanced portfolio that he would run for his clients. So he was holding a couple of years worth of portfolio expenditures in liquid reserves for them on an ongoing basis. And the idea was to essentially protect their cash flows for at least a couple of years in case the long-term piece of the portfolio encountered turbulence. And he noted to me, and kind of a light bulb went off in my head, was he noted that this really worked for his clients behaviorally, that he would call them during periods of market fluctuation and just to check in on them. How are you feeling about your portfolio? The market's been down lately. And his clients would basically say, Harold, I know, that we've got our cash needs set aside. So that means that we can still take that trip that we had planned to take next year. And we can still go out to dinner on Saturday night with our friends like we usually do. So all the things that we think of as constituting our quality of life, those are there. So we're not so worried about what's going on with the long-term portfolio because we know that the market usually comes back. And if we're patient, that will be okay. So I tend to think that from a behavioral standpoint in retirement, knowing that your near-term living expenses are more or less secure is an incredibly powerful thing. And so as I've kind of evolved on this bucket strategy over the past decade or so, and I've been writing and working more on it, I've come up with kind of a 3-bucket system. So in the system that I use, I think about bucket 1 as being the near-term portfolio withdrawals. Bucket 2 is maybe another 8 years worth of cash flows, and it's stepping out a little bit on the risk spectrum. So it's composed primarily of high quality bonds, maybe a little bit of inflation protection via Treasury inflation protected securities. Maybe you even hold a little bit of high quality dividend paying equities in this portion of the portfolio. But the idea is that with buckets 1 and 2, you've essentially built yourself a bulwark against a 10-year equity market drawdown. So for money that you expect to spend in year 11 and beyond, well, that's where you're taking risk, but you've built yourself kind of a runway of safe assets that you could spend through if you needed to. Just a couple more things on this bucket approach. One is how we arrive at how much goes into each of these buckets. And the way I think about it is using your total in retirement spending is sort of the starting point for this. So thinking about what you're spending annually, subtracting out any money that is coming in through non-portfolio sources. So Social Security for many of us, pensions for some of us, for those of you who have an annuity of some kind, that would all fit in there. So you're subtracting out those non-portfolio cash flow sources. And then the amount that you're left over with is the annual amount that you're leaning on your portfolio to supply. So just to use a really simple example, let's say my total portfolio, my total expenses each year are $80,000, and I'm getting $40,000 of that from Social Security. Well, the additional $40,000 would be a demand on my portfolio. So I'm using that to in turn inform how much I'm dropping into each of these buckets. So with bucket 1, I'm thinking about 2 years worth of those portfolio withdrawals. So in my simple example, if my 1-year portfolio withdrawal is $40,000, I'm just multiplying that by 2 and then on down the line. And then any money that isn't occupied in buckets 1 and 2 would be in bucket 3, sort of the growth engine of my portfolio. And what I like about this is that it allows the individual's own situation to inform how much goes into each of these buckets and in turn, how risky the portfolio is. So an example would be, say we've got a retired college professor whose pension is meeting all but say $10,000 of her annual living expenses. Well, you can see if she's using a structure like this and say she has $1 million portfolio, the net effect of that, of using her cash flow demands to inform how much to hold in each of these buckets, is the net effect is that she has very little in bucket one, so just $20,000 in bucket one. If she's got another 8 years worth of portfolio withdrawals in bucket two, again, very limited amount, even though it's 8 years worth of portfolio withdrawals, the portfolio withdrawals are really small, so limited amount in those two buckets. She's got a lot more in equity. She's got a lot more in growth because so much of her income is coming in through non-portfolio sources. Of course, that's not the setup that most of us have. Unfortunately, most of us will be making greater demands on our portfolio. But I like that portfolio spend informs how to allocate the assets. To me, I think it's just a very intuitive way to think about it. I just wanted to cover one more thing on this, which is how I arrived at that 10-year framework for equities, where we have 10 years worth of assets that we would be able to spend through before we would need to touch equities. And the reason is that when we look at historical returns from equities through rolling period returns, so various rolling 10-year time periods, what we see is that stocks are actually really quite reliable. If you have a 10-year time horizon, you're pretty fine holding stocks if you're not needing to spend for another 10 years. But if you shrink that time horizon, well, that's where the probability of having a positive return from stocks goes lower, uncomfortably lower, in my view, which is why I think you would want to think about setting aside at least 5 better 10 years worth of portfolio withdrawals in safer assets, because we have periods. A recent one was the period from 2000 through 2010, which has been called the lost decade in stocks. We have periods where stocks go down and stay down and don't really recover that can last a full decade. So I think 10 years is kind of a comfortable amount. Granted, it's kind of a luxury good, I think, for some of us. But if you possibly can afford to have 10 years worth of safer assets, I think it's a nice portfolio structure. So one other thing, and then I promise I'll leave this slide. One other thing is how you would go about spending from a bucket portfolio. And the thing to know is that it's not formulaic. So I think sometimes people look at this slide and see, okay, got it. I'm spending bucket one, moving on to bucket two, and then spending bucket three later. Maybe you would do it that way. So you would do it that way if you encountered a bad market environment early on in your retirement. But if you've been through retirement since 2015, for example, you'd probably be using appreciated equity holdings to supply your living expenses on an ongoing basis. So you may be spending from that cash bucket, but rebalancing out of equities to top up the cash bucket, leaving bucket two basically alone. So the idea is that you're staying flexible in terms of how you refill that bucket one. So you're spending from bucket one to meet your living expenses on an ongoing basis. As it gets depleted, you're being flexible about how you refill it. There may be a higher yielding environment at some point where the organically generated yields from bucket two, from fixed income assets, are more than enough to supply living expenses on an ongoing basis. We're nowhere near that right now. But the idea here is that you're staying flexible. You're not being dogmatic about how you refill that bucket one as you deplete it. So just a quick overview of the bucket strategy. My next slide is just a quick look at how this would look with an actual portfolio. So this is one of my model portfolios. It's an exchange traded fund portfolio. There are mutual fund versions. I've created all different versions of these model portfolios, not to sell anyone anything, but really just to illustrate, well, how would this work in practice using funds that we like, funds and ETFs that we like? So this is an aggressively positioned portfolio. It's roughly 60% equity, 40% bonds and cash. And so we're assuming a $1.5 million starting portfolio. And we're assuming a 4% withdrawal rate, which I'll touch on a little bit later on in the presentation, but we're assuming that we're using just the 4% rule to guide our withdrawals. So we're taking 60,000 out of the portfolio in year one of retirement, and then we're just inflation adjusting that dollar amount thereafter. So you can see if our $60,000 portfolio withdrawal is doubled, that's our bucket one. Another 8 years worth of portfolio withdrawals in bucket two. And you can see that I've kind of stair-stepped that portion of the portfolio by risk level. So I've started with short-term bonds. I included a position in short-term treasury, inflation-protected securities. I also have a good core bond fund as well. And then bucket three is the growth engine of the portfolio. It's basically a globally diversified equity portfolio. And you can see that I've included Vanguard Dividend Appreciation as kind of my anchor equity holding. The reason I like it is that it's a little bit higher quality than the broad market. But those of you who are more minimalist about your portfolios, you could reasonably use a total market index. If you have individual stocks, those could be a fit here as well. This is just a basic ETF portfolio. You can see that I've also included some lower quality fixed income products here that I've used Vanguard High Yield Corporate as part of bucket three. It's the last holding on the list. And the reason is that I like to think of investments like that as kind of equity surrogates or equity substitutes rather than fixed income substitutes, because when we look at their behavior, it's a lot more like equities than it is like fixed income. So I would hold them in my long holding period bin and think of it as an investment that may deliver a higher return over time, but it's also going to be pretty volatile. So I wouldn't want to have it in the safe portion of my portfolio. So one thing I want to touch on is what I see as the big drawback to this bucket strategy. I think there's a lot to like about it from an intuitive standpoint and from a behavioral standpoint, that knowing that you have your cash needs set aside can buy you peace of mind, as Harold Ovensky talked about with his clients. The big drawback is the opportunity cost, where we're looking at very low cash yields today, even though they've popped up just a little bit over the past few months. The starting point for cash yields is very, very low, and it's dead money or worse on an inflation adjusted basis. So you need to be careful about overdoing bucket one, certainly, because there's a high price to be paid for peace of mind. And I think you also need to be careful about overdoing bucket two, that high quality bond piece, for the same return, for the same reason that we know the return potential is very, very low. I do think that it's wise to have these safer assets as a portion of a portfolio, but you definitely wouldn't want to overdo the safe assets because of the return drag on the total portfolio. So just a caution, not that I need to convince many of you to not overdo bonds at this point. I think most investors really are not in love with bonds by any stretch, but this is the main drawback to a bucket strategy, is that it holds quite a lot in safer investments with low return potential. We talked on our podcast, my colleague Jeff Patak and I do a podcast together, and we've interviewed a lot of retirement researchers, and we talked to Wade Pfau, who is one of the leading lights in retirement planning. He's a great researcher, a great speaker. And we asked him about this issue, and he prefers other assets in lieu of cash in this context. He mentioned that potentially standby reverse mortgages could work, and this is a reverse mortgage that's available to you as sort of on an as needed basis, that you wouldn't necessarily have it going all the time, but something that you could tap in a pinch to keep you from having to tap your portfolio. He also posited, for those of you who have like permanent life insurance policies, the idea of having some kind of a life insurance cash value that you could draw upon whether life insurance makes sense in retirement in many situations is sort of a separate matter, but he viewed these other ideas as ways to potentially reduce the drag of cash on an ongoing basis. And then another idea would simply be that if you are using a bucket system and you come into retirement and encounter a weak market environment or worse early on, you could spend through bucket 1, spend through bucket 2, and simply not replenish buckets 1 and 2, which is kind of what that reverse glide path idea would have you doing, that you would go through, start retirement fairly conservatively positioned, and then ramp up in equities later in life. That's the basic idea here, and that reduces the drag of the cash and bonds on an ongoing basis. So just a couple of things to think about in the realm of what we're losing with this bucket strategy. Well, we're losing some return potential for sure. Want to switch over. I've spent a lot of time talking about portfolios. Want to just switch over and talk about withdrawals and withdrawal rates. This is a slide that my colleague David Blanchett prepared that looks at the right withdrawal rate over time, given different asset allocations. And what David's research finds is that the right withdrawal rate has varied completely by market environment. That generally speaking, more equity-heavy portfolio mixes have tended to be supportive of higher withdrawals over time, and lower equity exposures have tended to be supportive of lower withdrawals. I circled the area in sort of the early 60s through early 70s as a real influential period in terms of informing how we think about withdrawal rates. And this goes back to some research that was done by financial planner Bill Bengen, which many of you are familiar with, the 4% rule or the 4% guideline. Basically, he back tested different environments, looking at different portfolio setups. And his idea was, what would have been the most that retirees could have taken out if they happened to retire into the worst period in market history? And so that period from the early 60s through the early 70s was the period that he looked at. And what we can see from this slide is that it really didn't matter what sort of portfolio asset allocation you had in retirement. If you were using a 4% starting withdrawal and then inflation adjusting that dollar amount thereafter, that was the most you could have taken to ensure that you didn't run out of money over the subsequent 30-year period. So that's where the 4% guideline comes in. That's why we hear so much about it, because it's been taken through market history and shown to have held up pretty well. The question today is whether low yields, the combination of low yields and high equity market valuations call for a lower starting withdrawal making sense than just 4%, that we would need to be starting lower. So this is a slide from a research paper that my colleague David Blanchett worked on with a couple of retirement researchers, Wade Pfau, who I mentioned, as well as Michael Finca, who's another terrific retirement researcher. And their paper was really flashing warning signals about the risks of the 4% guideline, especially for people who have portfolios that are more conservatively positioned, which is what we're looking at on this slide. So we're looking at a portfolio with a 40% equity weighting, which is probably pretty low relative to what most of you have, but that just 40% equity weighting in the portfolio, you can see that the probability of success for various withdrawal rates is not great. And that is mainly because of the low yields associated with that fixed income portfolio. That because we know the return potential from that portfolio is so low that we really need to be careful with respect to withdrawal rates. Their paper posited that retirees who want to use that fixed dollar withdrawal system, fixed real dollar withdrawal system, need to be careful with their starting withdrawal rates. Again, this is mainly relevant to people who are just embarking on retirement If you've been retired for a decade or more, you need to worry less about this. Keep doing what you're doing unless you're taking some really very high withdrawal amount. You've made it through the danger zone. This is mainly food for thought for those of you who are early in retirement or maybe about to embark on retirement. So how do we think about withdrawal rates in this ultra low yield environment that we find ourselves in? Well, one of the key things to think about is that if you can be flexible in terms of your withdrawals, well, that goes a long way to helping protect yourself against a big equity market shock early in your retirement. So the Bill Bengen method, the 4% guideline, that assumes that the retiree wants to take a pretty similar dollar amount on an inflation adjusted basis year after year after year. And that means that if you're using such a system, you're not paying any attention to what's going on in your portfolio's value. You're just pulling the same amount year after year. Well, what you can gather from this is that that tends to be less beneficial in terms of helping the portfolio survive during one of these big equity market shocks. If you can be flexible in terms of your withdrawals, if you encounter that weak market environment, well, that goes a long way to helping your portfolio last. And there are a few different methods for being flexible. A real simple one that is probably familiar to many of you is simply using the required minimum distribution tables to guide your withdrawals. And you know that those are tethered to whatever your portfolio balance was at the previous year end, and that you also step up a little bit in terms of your withdrawals to align with your age. So that's a really simple method. There are a couple of more refined methods. One that I would call attention to has been developed by a financial planner named Jonathan Guyton that is called the Guardrail Strategy. And basically it's a flexible system that helps ensure that the retiree isn't taking too much in good markets and isn't having to survive on too little in bad ones. So if you're interested in that, you can find some good explainers on how the guardrail system works. Another strategy was developed by Bill Bengen himself as kind of a refinement to the 4% guideline. That's sometimes called the ceiling and floor method. So if you're interested in reading more on those, you can see some information. Vanguard also did a similar study with ceilings and floors using a flexible withdrawal rate. It's also important to think about when you're thinking about your own withdrawal system, your own withdrawal rate, thinking about the asset allocation of your portfolio. So certainly if you have less in equities, you'd want to be more conservative, as we saw on that slide that showed the low probabilities of success for portfolios that are heavy on safe assets. You also want to factor in your age. You should be able to take more from your portfolio as the years go by because your time horizon is declining. You want to think about your portfolio's performance and your balance. And then you want to think about your actual expenses. I think that's something that doesn't really get discussed in the context of withdrawal rates, but it's such an important point, which is that things evolve and change throughout our retirements. The data suggests that the early retirement years tend to be the high spending years, with spending kind of leveling off for many retirees in kind of the mid 70s period, and then going up a little bit later in life. So I think factoring in your own spending trajectory is important, recognizing that your own spending will probably be a little bit lumpy from year to year. You might have heavy travel years where you're spending quite a lot, and then you may have, we hope none too soon, but you may have repeats of 2020 where many of us were in a pretty low spending period simply because there weren't many spending opportunities. So I think it's definitely worth thinking about your own situation and your own planned spending trajectory when thinking about your withdrawal system. I like the idea of, as you embark on retirement, really plotting out at some level of granularity what you're expecting to spend each year through retirement. So, you might know, well, okay, my car is 6 years old. I'm planning to replace it in 3 years, whatever. You may be able to forecast where you'll have those extra expenditures. So I think that that's kind of a neat thing to do as you think about retirement. Just a little bit on in retirement withdrawal methods. So I mentioned this just at the top of the presentation. The old school approach for thinking about where you source your portfolio cash flows is just using some sort of an income focused strategy where you are pulling from whatever income your portfolio is organically able to generate. And this slide just depicts the yields from various fixed income assets. And you can see that they're really, really low. This is something I've already talked about. So for retirees who are inclined to subsist on current income, to the extent that their portfolios include fixed income assets, you can't expect a lot unless you take a lot more risk in the portfolio. So there are a couple of ways to think about methods for withdrawing from a portfolio. You could also use dividend yields, and I know that there are probably many dividend yield enthusiasts in this group where you're using equity dividend yields to fund a portion of your cash flows. I'm fine with that. I think you just need to stay mindful of the downsides that are associated even with high quality dividend paying stocks. So I've just included here the current yields as well as the period during that mini bear market we had in 2020, early on in 2020, where you can see that, yes, these securities continued to provide dividends. We've seen dividends come down a little bit, but there's also a lot of volatility potential. So I get a little nervous when I meet retirees who tell me that their portfolios are largely dividend focused stocks and they don't have much in safe assets. Unless they're super comfortable with volatility, my preference would be for them to hold some safe assets along those dividend paying stocks. So even if they're using dividends as the anchor for the portfolio. I just wanted to talk quickly about a couple of strategies for extracting cash flows from an in-retirement portfolio. One would be to use sort of a pure total return approach where I am just periodically rebalancing my portfolio to get its asset allocations back in line with whatever my targets are, and using the appreciated assets to fund my cash flow needs for the years ahead. That's one way to think about it. If I were to talk to some of my colleagues in our investment management team, they would say, by all means, that's the way to do it, because that has the advantage of giving you an opportunity to reduce risk in your portfolio periodically. If you're trimming what's gone up the most, you are also reducing risk in that portion of the portfolio. So for example, if you've been periodically trimming your US equity assets, you've been supplying yourself with cash flows on an ongoing basis, and you've also been taking some risk out of the portfolio. So that's the pure total return approach. Another idea would be to use kind of a hybrid strategy where most portfolios are generating at least some income on an ongoing basis. So you are spending them as you receive those cash flows from your income producing securities, or you're using them to refill bucket number one. And then you're periodically harvesting, rebalancing proceeds to supply additional living expenses. So I think that that's another way. It might be sort of behaviorally attractive as well, because if you think about a portfolio today, you might be able to generate like 2% of what you need from income producing securities. That means that you're only going to have to find another 2% through rebalancing your portfolio. So that hybrid strategy, I think, holds some appeal as well from a behavioral standpoint. Just want to touch real quickly, and then we're going to break and get into the other presentation, the implications of the current environment for non-portfolio income sources. Well, the short answer is that it makes them more valuable. Many of you have heard people like me evangelize about the value of delaying Social Security filing if you possibly can. And the fact is that that benefits enhancement that you receive for delaying hasn't been changed, despite the fact that we have had yields go through the floor over the past decade. So you can increase your benefits from between 76 and 77% by waiting from age 62 when you're first eligible to file for Social Security, all the way to age 70 to file for Social Security. And one point I always make on this front is that no one's saying you have to keep working until age 70. It may mean that you are withdrawing more from your portfolio early on in retirement, but you certainly wouldn't need to work. You just would delay Social Security while looking to other sources for your cash flows. And the other point I make is that there is a benefit to be gained by delaying even a year or two past your full retirement age, if you possibly can. Many people can't, but if you have the flexibility and you're in good health, importantly, it can often make sense to delay. One website I would direct your attention to is just a really great free tool for exploring different Social Security filing strategies, and it's called Open Social Security. It's a tool that was developed by a fellow named Mike Piper, who's just a great resource. He has a website called obliviousInvestor.com, and he's developed this free tool. And I've spent some time playing around with it. It's really interesting. You can plug in different variables. It's especially helpful for married couples where we know that Social Security filing strategies are really impactful, especially if you have a married couple with different ages and or unequal earnings histories. You can play around with the variables. The tool also lets younger people give their benefits a potential reduction if they're concerned that there will be changes to Social Security going forward. They can reduce their benefits accordingly. So it's a helpful, useful tool for those of you who haven't made your decision about Social Security filing. I would urge you to get on there and check it out. It also lets you factor in different health forecasts or different health outlooks. So that's helpful as well. Annuities, I'll just touch real quickly on annuities. And I know they're a dirty word in some circles, perhaps for good reason. There are a lot of terrible annuity products that are really high cost, very opaque. But the fact that we have yields as low as they are today, I think that does embellish the attraction of annuities somewhat. So the payout that you receive from an annuity, a very simple annuity, is also influenced by what is going on with the yield environment, in that the insurer that you're engaging in this contract with can only offer you as much as it expects to safely be able to earn on your money. And so they are impacted by the current bond market environment as well. But the advantage to an annuity in this environment, even in a low yield environment, is the fact that as an annuity buyer, we're in this risk pool with other people. And the insurance company knows that some of those people will die early and not get their money's worth. Some will die much later and get more than their fair share. And so that fact, that what insurers call longevity risk pooling, that fact allows the annuity to offer a higher payout to all of the annuitants than it could if it were just offering that annuity to a single purchaser who's not sharing that longevity risk with other people. So I like the really simple annuity types, just a single premium immediate annuity. There are also these deferred income annuities that work pretty similarly, but the basic idea is rather than starting payments from the annuity immediately, you would start them at some later date. So a common configuration with these DIAs, as they're called, deferred income annuities, would be that I would buy at age 65, but then payments would not commence until age 85. And the nice thing about such a product is that, you know, maybe I'm looking at my portfolio and saying, I'm comfortable, more than comfortable for years 65 through 85. I'm not at all concerned about my portfolio lasting. What I'm concerned about is the fact that I have some relatives who live to be 107 or something like that. I'm concerned about being one of those people who lives a really long time and running out of money after age 85. So the deferred income annuity would come into play later on in life. It's worth considering, not a very broad market at this point, but when I talk to retirement researchers, there's a lot of enthusiasm for these types of products. Just a quick rundown of other things that I think about. First one, I'm a state of Illinois resident, so I pay attention to what's going on with state and local finances. I think that there's a lot to be concerned about in certain states, certain municipalities, from the standpoint of, just what we might expect over the next couple of decades in terms of tax rates, especially. The Social Security Trust Fund is also getting closer to depletion. So I think it's scheduled to run out in like 2035, unless there are some adjustments made to shore it up. And then quickly, a topic that is near and dear to my heart because I had two parents who had a long-term care need later in life. The long-term care marketplace is still a very troubled marketplace where the insurance products have been really complicated, really not great for consumers, where we've seen insurers push through some really high rate hikes on people who thought they were doing all the right things to purchase long-term care insurance. We also know that COVID has had a disproportionate impact on long-term care settings, people living in long-term care. The mortality rate for COVID in long-term care settings has been so much higher than in the general population. So I think a lot of retirees are rightly considering whether they want to receive long-term care in an institutional setting at all. So a complicated topic, one I'm happy to talk more about in the Q&A period. So we'll just pause it right there. I think we possibly have room for a few questions here. And I will also project my email address here, a little bit more information about how to reach me. I can't give anyone any personal financial guidance, but I'm happy to respond with links or other things that might help answer your question. I'm on Twitter, and my colleague Jeff Patak and I mentioned do a podcast together called The Long View that I would urge you to check out if you're interested in hearing us interview people who we consider to be thought leaders in some of these areas. So I'll just pause it right there. And I think we have time for a few questions here, and we can tackle them as we have them.
Okay, Celia, you want to queue up a couple and then I'll do a couple of questions? Well, I'll just go ahead. There was a question earlier, and let me move up to it. And that asked, how do you analyze or determine future value, FP?
Yeah, so the fair value, good question. So I mentioned early on in my slides that we have this equity analyst team, and we asked them to do discounted cash flow analysis to arrive at what should be the fair value for the companies in their coverage universe. So we asked them to think about what the company should be worth based on what they expect its future cash flows to be. So we use a DCF model. We also factor in, and I'll touch on this a little bit in the course of the next presentation, we also factor in in terms of the overall rating for a company, we factor in the quality of the business, the durability of the business. So a concept that's real important to us in terms of our equity analysis is what's called a moat. And this is a Warren Buffett concept. It basically means, do we think this company has some sort of sustainable competitive advantage relative to its peers in that same industry? And so a higher moat company would generally be able to have a higher fair value than would be a company with no or narrow moat.
Thank you. Another question, and just comment in general about this. For bucket one, rely on home equity loan or reverse mortgage?
Yeah, it's a good question, and I think it's possibly an idea for reducing the ongoing drag of bucket number one. I do think that there's some behavioral things that work with respect to reverse mortgages. I know a lot of older adults really are disinclined to tap into home equity to help fund their in-retirement expenses. But certainly when you think about sort of the efficiency of someone's total asset allocation picture, the idea that you would have this asset that you would leave absolutely untouched, even though it might be the biggest share of your household's net worth, it really doesn't make sense from the standpoint of optimizing a portfolio, optimizing a plan. In fact, Alicia Manel, who is a retirement researcher, one of the leading lights in retirement research, has done a lot of work on this particular issue, on the role of reverse mortgages. And I think it's an especially worthwhile area to consider for those of you in Silicon Valley, and where your property values have just gone through the roof, where many of you, very likely, if you've been homeowners for many years, are sitting on a lot of home equity. I think it's definitely worth exploring for people who want to try to optimize their plans, that you might get your home equity in on the action in some fashion. I recently had a question about how family members, well-off younger family members, could help parents through retirement if the parents were in somewhat constrained financial situation. And my advice was, well, first thing, try, if your parents are homeowners, try to get them comfortable with the idea of some sort of reverse mortgage, because oftentimes that's an underutilized asset hiding in plain sight in many households.
Okay, and you've actually answered one question in doing that. I've got two about Roths and IRAs, so I'll just ask them and then you can perhaps weave it into one answer. What do you think about portfolios with a combination of IRA, Roth, and taxable options? How does this mix affect withdrawals? And then second question, opinion on converting IRAs to Roth and keeping Roths for tax advantage, maybe high risk investing.
Yeah, there's a lot there, but in response to the first question about whether it makes sense to hold assets with multiple tax characters. So you really have three main bins. You've got traditional tax deferred, and that might be an IRA, it might be some sort of company retirement plan where you have never paid taxes on those funds. You've been putting pre-tax dollars in or getting a tax deduction on your contributions. And so you will owe on, when you pull the money out in retirement, you'll pay taxes on the whole thing. So that's one camp. The other would be Roth, where it's just the opposite, where you're putting after-tax dollars in, but your withdrawals are tax-free. And then the third basket would be taxable assets, where you are putting after-tax dollars in. Obviously, you're earning some money, and then you're paying on the money that comes out at a capital gains tax rate. So definitely tax diversification is a benefit. We talk so much about having different assets in a portfolio. Well, I think you also, as you're accumulating assets for retirement, spreading the money around can be a great strategy. And the basic reason is that, especially for those of us where retirement is several years away, we're not really sure what tax regime will prevail when we're retired. We may have our own personal tax situation go higher, where we may be pulling money out because we're pulling more money out and we're paying taxes at a higher rate in retirement, or we may just see taxes secularly go higher. So I think that embellishes the idea of amassing assets in each of the three major account types. In terms of deciding how to pull the money out in retirement, there's been a lot written on this topic, and it's complicated. But the basic idea is that the questioner's instinct was absolutely right, that when you think about Roth assets, that's money that you've already paid taxes on. So it will be tax-free when you withdraw it. It will also be tax-free money when inherited by your heirs. So they will have to take required minimum distributions from the Roth IRA, but it's tax-free money to them. So generally speaking, if you have Roth assets, the advice is, if you possibly can, put those funds in kind of the save for later bin, because you want to stretch out the great tax advantages of those accounts. When we look at the other two, taxable and tax deferred, Well, they're a little less attractive. And the taxable would be especially less attractive because to the extent that we're earning income in those accounts, so say I have a dividend paying ETF in my taxable portfolio. Well, I'm having to pay taxes, dividend taxes on each of those, on the dividends as I receive them. And I'm just not getting a great tax break to hold my assets in that account. So the sort of conventional wisdom about sequencing withdrawals in retirement is to spend taxable first, followed by tax deferred, followed by Roth. But I would also say you don't want to be dogmatic about it. That through retirement, you want to preserve a little bit of flexibility to pull from maybe each of those three bins. And it's pretty personal. It depends on how much we have in each of those bins. And this is a great area, I think, if you've got a CPA who you work with on an ongoing basis, or a financial advisor, to get some advice on a year-to-year basis to, maybe say, okay, we have really high deductions this year for whatever reason. Maybe we made a huge charitable contribution, or we have a lot of healthcare deductions, or whatever it might be. You might get the advice, well, okay, this is a good year to pull from your tax deferred accounts because you have a lot of these offsetting deductions. I'll just touch real quickly on the last point about conversions, the question about whether it makes sense to do conversions. And the question really depends on the individual. But the key thing you want to be thinking about is whether you expect your tax rate at the time you begin to draw from that account to be higher or lower than it is at the time you do the conversion. So 2020 is a great example that for a lot of people, their withdrawals were lower, or their income was lower in that year than it would be in other years of retirement. So 2020 was a good year for many people to have considered doing conversions because they were likely in a low marginal tax rate than they will be in the future. So it's definitely a place to get some help, get some advice from a tax professional to see whether making those conversions make sense. In some cases, it may make sense for older retirees where their period of time to recoup the taxes that they're paying at the time of conversion is less. There may be a little bit more reason to not be super aggressive about conversions, but definitely get some tax help before embarking on this. And the other thing is, as of a few years ago, you can no longer undo conversions. You used to be able to do this thing called a recharacterization, where you would be able to, assuming that you recharacterized within a specific period of time, you were able to kind of undo your conversion. That's not an option anymore. So if you're considering conversions, you need to be quite sure before you embark on them.
Good, thank you. We have two more questions, but they're going to take, I think, too long. So we'll move them into the second period. But thank you very much. We'll take a 10-minute break. So basically, we'll be starting up about 10, 36, 37, 38, basically a 10-minute break.